Index funds versus mutual funds versus hedge funds versus ETFs explained. Introduction. Are you tired of seeing your money sitting idle in a savings account while inflation eats away its value? Do you want to start investing but feel overwhelmed by all the confusing options available? If yes, then this video is exactly what you need. Today, we are going to break down 4 of the most important investment vehicles: index funds, mutual funds, hedge funds, and ETFs, in the simplest and most practical way possible. By the end of this video, you will clearly understand the real differences between them and finally decide which one is best for your money. If you are serious about building long-term wealth, then stay with me till the end. Hit the like button right now if you want to grow your money smarter, and don't forget to subscribe to the channel and turn on the notification bell so you never miss future investment guides like this. Mutual funds. Mutual funds are pooled investments where money from thousands of investors is collected and actively managed by a professional fund manager. The manager buys and sells stocks, bonds, and other assets with the aim of beating the market. These funds are very popular among regular investors because they offer diversification, professional management, and the flexibility to start with small amounts through SIPs. However, because of active management, they charge higher fees. Expense ratio. There is no performance guarantee. If the manager underperforms, your returns can suffer. Mutual funds are good for those who want expert management but are okay with paying extra fees. Index funds. Index funds are a special type of mutual fund that work on a passive strategy. Instead of trying to beat the market, they simply copy a market index like Nifty 50 or S&P 500. The fund manager does minimal trading and just holds the stocks in the same proportion as the index. Because of this, index funds have extremely low fees, often less than 0.2% per year. Over the long term, they tend to outperform most actively managed funds after deducting fees. They are simple, transparent, and one of the smartest choices for beginners and long-term investors who believe in steady market growth. ETFs. Exchange-traded funds. ETFs are very similar to index funds because most of them also track an index. The major difference is that ETFs are traded on the stock exchange throughout the day, just like normal shares. You can buy or sell them at any time during market hours at the current price. They offer very low costs, high liquidity, and excellent flexibility. You can find ETFs for stocks, bonds, gold, specific sectors, or even international markets. ETFs are perfect for both new investors and active traders who want low fees along with the ability to trade quickly. Hedge funds. Hedge funds are the most exclusive and aggressive option. They are only available to wealthy, high-net-worth investors. Hedge fund managers use advanced and risky strategies like short selling, leverage, derivatives, and arbitrage to generate high returns in both rising and falling markets. They charge very high fees, usually 2% management fee plus 20% of the profits. While the potential returns are high, the risk is also much higher. Hedge funds are not suitable for average investors due to high minimum investment, lock-in periods, and complex strategies. Cost: index funds and ETFs equals lowest. Mutual funds equals medium, hedge funds equals highest. Management: index funds and ETFs equals passive, mutual funds equals active, hedge funds equals very aggressive. Risk: hedge funds equals highest, mutual funds equals medium high, index funds and ETFs equals market risk. Liquidity: ETFs equals highest, mutual funds and index funds equals good, hedge funds equals lowest. Who should invest? Index funds and ETFs equals best for most people, mutual funds equals those who want active management, hedge funds equals only for rich investors. Conclusion: for most people, especially beginners and salaried investors, index funds and ETFs are the smartest and most profitable choices in the long run because of low costs and strong performance. Choose mutual funds if you prefer active management, And stay away from hedge funds unless you have very large capital and high risk tolerance. The key to successful investing is starting early, staying consistent, and choosing the right vehicles according to your goals and risk appetite. If you found this explanation helpful, please like this video, comment below which fund type you are planning to invest in, and subscribe to the channel for more simple and powerful investment guides every week. Turn on the bell icon so you get notified immediately. Share this video with your friends and family who also want to learn about investing. Thank you for watching, and I will see you in the next video. Keep learning and keep growing your wealth.